Welcome back to another episode of the David Siddons Better Decisions podcast. This is the David Siddons Group. I'm David Siddons. I'm here with Dylan Fonseca from Centro. Centro is a real estate fund. This is a different kind of podcast. I am a real estate broker, and normally, obviously, I'm processing all of my conversation around selling houses and condos. This is different. For me to actually get in and talk through a fund is a move in a slightly different direction. Dylan, thank you for doing the podcast with us. Before we get going, I'm actually going to thank our sponsor. We have a sponsor now, Smush Espresso Coffee. This is something that I picked up on, and I met with the owners of the company, decided I like the coffee because I drink a lot of coffee every day. If you're a realtor and you're watching this, and I know a lot of our audience are, I find that I have way too much caffeine in my diet. This has been an amazing life-saving alternative for me, where I can get the benefits of coffee without the caffeine jitters. So thank you for being our sponsor. Let's move on into the podcast. Dylan, thank you for doing this. I'd like you to start off by introducing yourself and your business, what you do, and then we're just going to start diving into some questions, and I've got a lot to ask you.
Thank you very much. I'm very happy to be here. We are what we call real estate owners and operators. So we buy cash flowing real estate, and then we invest in it, we own it, and we operate it through a fund, and we stay as long-term owners. So yeah, basically that, shopping centers and multifamily.
So the real estate fund business, to the average person on the street, is really like an unknown thing. Like, most people call me and say, I'm going to buy a house, I'm going to buy a condo. I can understand that. I can get my head around that. Let's start off by explaining how these funds, like, what is a fund and how does it actually work? Like, how does it operate?
Sure. I think most people don't know about them because they're intentionally, or not even intentionally, they're just, it's a question of access. You have to have a certain economic level to participate in them, and you have to really know how to get in because they're very complicated businesses. They're not for every single person. What they work essentially is you have to think of it as a company. It's people coming together in the form of a company, an LLC or a limited partnership, to come together with the sole purpose of owning a collection of assets. So a fund is just a company that then owns a lot of shopping centers or multifamily buildings inside of it. And the price points tend to be relatively high, and that's why they can sometimes be somewhat exclusive.
So people will come to you, they'll pick up the phone, they'll call. And again, if you're watching this and afterwards you want to know more and understand it, pick up the phone, give me a call. I'm going to make an introduction for you straight into Dylan's world, and you can discuss. But the funds, we're talking about price points around what, $15-20 million you were saying earlier?
Yeah, so normally we'll look at what we call middle market assets, which can be anywhere from about $15 million to $50 million. Okay. And that's where we find ourselves the most effective and just where there's the largest margin for us to make good returns for our investors.
So let's say I have $1 million. I'm going to come in. I don't know anything about investing in funds. And I'm going to say, okay, so what's the next step? How's it going to work? I'm just going to, why are you $1 million?
Sure. So these funds tend to have these periods of time, right? So right now, for example, you're catching me at a time where our last fund is closed. So that fund is fully invested. It's bought a bunch of assets and it's now closed, and everyone's just in there getting their returns on a monthly basis. We're in the process of launching another fund. So what that is right now we come up with a new strategy, a new thesis that reflects today's investment, environment. Like, what's available to us today? What's the best returns, risk-adjusted returns we can give? So we come up with a thesis, and then we start to market it. We'll go out and we'll talk to different people. We'll show them. We'll say, hey, we think this is going to happen in the market, or that's going to happen in the market. And if they agree, they say, we're in. They sign a commitment to the fund. And what that is let's say, to use your $1 million example, you're going to say, I'm in with $1 million.
Okay.
The first step's going to be is you just sign that commitment. You put up somewhat of a deposit, a lower deposit amount to show that you're serious about it. And then as we need the funds, we begin to draw down on them. So if the total fund is going to be $25 million or $50 million or $100 million, we're only going to call your funds in proportion to the total ownership as we need them. So if we buy an asset that's 10% of the total fund amount, we're going to say it's time for you to send in the next 10% of your money. So we have these things called, deployment periods. So there's a period of time in which the fund is buying deals, and as those deals are being bought, we're calling your capital. And you've made the commitment to give us that money up to the total amount that you decided to give. Then there's kind of just an operational period where we just run the assets. We're not buying them anymore. We've put everyone's money to work. And then there's a harvesting period where we're selling off the assets because we're reaching the end of the fund life.
So breaking it down, the fund is about a 7-year fund.
Mm-hmm.
I come in, I've got $1 million. I'm going to sit down with you. That money is going to go into an escrow account, or it's going into...
Yes.
So it goes into the escrow account. The money goes in, and then you accrue all the money together from all those investors. And how many typically do you have in a fund?
So in the last 150 million we did, it was maybe about 47 to 50 people.
Okay, so 47, and that's obviously slightly bigger. I mean, you could have smaller funds of, say, 15, 20 million,
sure,
where you might have, like 10, 15 people?
Yeah, absolutely. We don't like to go below $1 million per person, really.
Okay, so $1 million, let's use that as a good threshold, because I understand that once you get into very small amounts, it gets more complicated. But $1 million, and there's a lot of obviously investors out there that are looking to deploy $1 million right now. They may be looking at returns, and we're going to get into the returns because this is when it gets interesting. When I start giving you the numbers on returns, and this conversation is about investing, I was like, when you told me, I was like, what? That's it. That's insane.
Yeah.
But I'm not going to get into that yet. So I give you $1 million. And then the asset, the actual deed, like normally if I buy a condo, I get the deed and it's my name, and you go on the tax roll and you see I own it. Okay, so who owns it? The company is owning it. The fund is owning it.
Correct. The fund owns it,
yeah,
and you own a piece of the company.
So you have like a fraction ownership.
Yes.
Okay.
You essentially sign 2 documents when you enter a fund. I'll just simplify it and call one a subscription agreement.
Okay.
And the other one an operating agreement.
Okay.
The operating agreement is the rules of the company.
Okay.
How the company makes decisions. Not everything is just what I say. There's majority rules type decisions. So you have the operating agreement, how we treat the company, the subscription agreement, which is how your money is treated, what you're buying. You put it in, it says what percentage you're going to own, all of those types of things.
So you put your money in, and let's say you've got 15 people around you all putting their money in. It's going into this pot. And then how is the decision that you as the company, you're the ones deciding on what assets to buy?
Correct.
Okay. So how do the people, the members of the fund, understand and learn about what you're going after? Do they learn from the beginning, and you're going to say to them, okay, guys, this is what we're going to go after. This fund is going to focus on retail space in this location, and we want to go after, I don't know, let's say a Whole Foods.
100%. That's what we call our investment criteria.
Okay.
So we'll say we're going to buy shopping centers in the Southeast.
Okay.
And we're going to look for them to be, either grocery anchored or anchored by a national, like, public company.
So you get to own a little bit of, let's say it's a Whole Foods.
Yeah.
So you can go out there and you can walk into that Whole Foods and go, I own a piece of this Whole Foods.
Yes.
This is mine.
You might not want to bother the manager or ask for a discount or anything, but you do, in fact, own a piece of that.
And I know some clients, and this is why it always gets interesting, because at the high level, there are clients of ours who are extremely wealthy. Let's call it like FU money. They are extremely wealthy, and the world that they play in is a closed-door environment that almost seems exclusive for the people who have the kind of hundreds of millions of dollars of liquidity that they have. And very few people in the world can go there. It's like that saying, money begets money. When you've got it, you're controlling the game.
Right.
What you're saying is that this is what this fund does. It wins you a seat at the table to play with the big boys when normally you couldn't play.
100%. Look, at the end of the day, there's not that many people that are going to go and plunk down $25 million on a deal, right? And even if should they decide they want to, the thing is there's so many people like us or other companies or institutions, your big institutions, your pension funds of the world, your private equity companies that are also doing so, that there's enough of us that there's not really the need for new entrants. So you show up, you say, this is the first time I've ever looked at a shopping center. I want to buy one. I've got $25 million. There's a very high chance the broker is going to say, I don't know if we should pick that, because that gentleman might not know or that one might not know what they're getting into. And that's what we call execution risk. At the end of the day, when someone decides to sell, and I'm sure it's the same in your business, if you see someone that doesn't look that serious or like they don't know what they're doing, you'll favor another buyer.
100%. 100%, because, you want, I don't say the path of least resistance, but you want certainty. Everybody is looking, when you're doing a business deal, you want to see follow through. And yes, if I get someone who comes to me and they might be very liquid and they're like, you know what, I want to engage with you to invest over here. If I don't think that they're savvy to it, they have the appetite for it, it's very likely that they're going to start to get jittery. They're going to start to get confused thoughts in their head, and they probably won't execute. Of course, I want the people who know what they're doing and they're going to follow through. And that happens in every transaction I can possibly think of. So I get it. Your space I found interesting because before we started rolling the camera, as we always do, we talk with the guests and we understand like the business and how it works. And this is our second meeting. We've actually met before. We sat down, we had lunch, and you took me through it. And you were introduced to me through Eli Braha, who's a dear friend and a business colleague and runs the FIU Hollow School of Real Estate. And he said, hey, there's a guy you need to talk to. And I was like, okay, I'm open. And when I sat down with you, we started to go into your business. And I realized very quickly that you sit in a very good space. You're not too small and you're not too big, but you work in the space that these deals come to you because you're established and you're part of the, a part of the system.
Absolutely, 100%. That was the hardest part, I would say. And the good news is I've been doing this for 20 years. And the good news is that before starting my own firm, before starting Centro, I ran asset management for a very large company here that had about $1 billion in management, 5 million square feet in Florida. So I already knew who all the players were. And, probably while at that firm, I bought and sold $350 million of real estate. So you immediately get to know all of the investment sales brokers.
Yeah.
To show you how small this world is, there are 3 companies that I would say sell 85% of the types of shopping centers we're discussing. And those 3 companies, the people in the state, that breaks down to 6 people at one of these major national companies. So
you're talking about the CBREs and the Cushman Wakefields,
the JLL,
and the JLL. These are the big players.
Correct.
And obviously you've I'm going to say been in bed with these guys. You've done business with these guys for so long. So
they know how we've behaved.
Just like in our business, just 100%. Like in the residential business, I look around and it's been, over $2 billion of transactions that I performed over the years. And if you look at the top 10 agents in South Florida and in Miami, it's the same players again and again and again. And because we're used to transactioning with each other all the time, if I go and call up, Julian Johnson, or I call up Dora, or I call up anybody else that I do a lot of business with, I know that we're familiar with each other. We know our business. We know how we're supposed to operate. We know how we're supposed to do deals. And unlike if we get someone who's never done it before, I'm always going to say, all right, I know this person has a pedigree and they're going to be able to execute.
What everyone wants to know is how it's not uncommon to have some type of problem in a transaction, something that was just a misunderstanding in the property between the parties, or something that maybe the selling party didn't even know about. The question is, if you're the buyer, how are you going to react to that? What's going to be your ask? Is your ask fair, or are you trying to, jam the person because you feel like you have a leg up on them? So our business, because it's so repetitive and so reputation driven, it's extremely important that you behave like a repeat customer. If we find something was wrong in the roof, well, what's the cost of fixing it? Should it have been expected? If the roof is 40 years old, I can't go into the seller and say, what a surprise, there was something wrong with the roof. And everyone's gonna say it was a 40-year-old roof. Like, you've been doing this long enough, you should know that. Or if it's something that maybe nobody expected, they're gonna say, well, that's a $50,000 problem. We're gonna give you $50,000 off the purchase price. And that's fair, and that's just, and that's how it should be done. If you come back and say, I want $3 million off, then it's called a retrade, and I'm sure it happens in your business as well.
Yeah, it does. This is a very familiar area. Our businesses have actually a lot of synergy because, I am working towards how this business works and what kind of money it makes. But our businesses work in a very similar way, and I found a lot of familiarity when we were talking because both of us are students of human behavior. We're studying the demographic profiles within our markets. We're looking at how people make decisions.
Yeah.
Ironically, the whole name of this podcast is Better Decisions. And when we're studying and making decisions for our clients, we're looking at how the human behavior and the data that we're getting from the human behavior allows us to see a little further down the road.
Right.
And that is enough distance to allow us to give clients, whether it's I'm selling a condo to a client or a house, and I'm going to say to them, hey, I can, and I say predict, but I can see from the data that I've got and the historical performance that's happened and all the variables that I see happening in the market that I can expect there's going to be a better return on this asset than this asset, and here's why.
Right.
And that's very much what you do. But you also, like myself, I have my own data and software that I developed. You have too.
Yes.
And your data is like...
Well, thank you very much.
So the data that you get, just give me a little bit of that. And just so I don't tease you anymore, the returns we're talking about, and we're going to get into this in a second, the returns that we're talking about in your business is on a 7-year fund, you're talking somewhere around 8%, can be a little bit more per year.
Right.
And then at the end, when you trade that asset off, you've got upside of what could be 30 to 50%.
Right. So essentially on a cash basis, meaning you put in $100, you're getting $8 a year. And we pay the dividend monthly. Now, what also happens is that the asset also appreciates. So when we sell, like you say, it has a 30 to 40%, appreciation. So kind of when you compound that and take it all over the year, we use a metric called internal rate of return. Depending on the risk that we're taking, it's going to be somewhere between 15 and 20%. It's going to be equivalent of getting a 15 to 20% return every single year throughout the hold.
For 7 years.
7 years.
That is so significant. And the risk on it is actually much less than you might see in other sectors, because essentially you're buying the land and it's the tenant's responsibility, like Whole Foods, to actually maintain that. So if there's something needs to be fixed,
right,
it's their problem, not yours.
It's ours in that we have to fix it for them. It's theirs in that they have to pay for it.
Okay.
And that's why these are called net leases. So a big issue facing other asset classes right now that are what we call gross leases, the opposite of that. If something happens, the owner pays for everything. In retail, it's different. So insurance is a big deal right now.
Yeah.
Insurance has gone up 30% last couple of years in a row. Seems like it's getting a little better.
And we're having a podcast tomorrow with an insurance expert to look at that, talking about Citizen and what went on with that group and how that's affecting us. So that's a very relevant subject.
So that insurance goes up 30%. We fight it. It's our fiduciary responsibility to do so. And we want to keep the costs as low as we can, because our tenants, the less they pay in expenses, the more they can pay in rent. So we do try and control expenses 100%. Now, what will happen is if insurance does go up 30%, the pro rata share of that increase, so if Whole Foods is half the shopping center, half of that increase is going to Whole Foods. Mm-hmm. The other half is being paid out proportionally by the rest of the smaller tenants.
It's not coming out of your pocket.
No.
It's coming out of their pocket.
100%.
And that's the big difference. That's the big
difference.
kicker from what you would get in residential. Now, you might think to yourself, why is David, who sells residential real estate, talking about a fund which might be diverting investors away from real estate, a condo, a house? Why? Because I try to look things holistically, right? There's a bigger picture at play here, and I'm trying to be aware of all the pieces of the puzzle. Right. And I think this is, part of the good conversation. If you want good investment advice, I'm hoping that you're tuning into this podcast to get exactly that.
Yes. And
you're getting it without bias, and you're getting it without me trying to shove a product at you because it's in my interest. I'm trying to make you aware of everything. And this is something that I think is extremely important. Now,
just to stay with that, I think really quickly, a couple of years before now, I think there were very compelling arguments for people to invest in industrial and people to invest in multifamily. There were moments of time where the need for space, for distribution, for everything was driving industrial at a rate that made so much sense. The same as the shortage of rental housing in the United States. Now, that's been beleaguered by some of the expense problems we just discussed. So that's maybe not the best time right now. Maybe it's coming back. We'll see. So retail's having a really nice moment right now where I think a lot of the smartest institutions are seeing it as well. And we're seeing people move back into this space in big numbers, because we always talk about returns as risk adjusted. Okay. Where are you getting the best return for your risk, not just the best total return, but the return for the amount of risk that you're taking. Mm-hmm. And the retail sector is very healthy right now. Tenants are selling a lot. Consumers doing very well. So it's a great time to be a landlord in retail.
And that actually kind of leads into where the question was going on before we got into this, is how you're actually reading that data, like
sure.
Pulling that together, how to back up what you just said. Retail's having a great moment right now, and we saw a little bit of like the multifamily and industrial having a bit of a softening. What data are you pulling, and how do you gauge that statement that you just made to substantiate that?
100%. So I'm going to take a quick step even further back to talk just about the data in general. So like yourself, like our common friend Ellie, we're very data-driven people. Mm. We have access to amounts of data that's unprecedented, that's never been seen.
And that people don't have access to. That's Correct. The other thing. We own our proprietary softwares and respective data sets, and we're cross-referencing our data sets
Absolutely.
With each other, which 99% of the people out there don't have access to this information. I guess they're flying blind.
Right. It's, asymmetric data is the best way to make money in a business, where you know something about something that other people don't, and you can monetize that.
Yes.
That's what we seek to do with our data. So when I got into this business, like I said, I've been doing it for 20 years, but I have to compete with people that have been doing it for 40 years. So one of the sources of alpha, or the sources of advantage for us that we've always looked to, is how can we get more data? How can we analyze it better? So I'm an adjunct professor at the University of Southern California. I'll do a lot of projects with my students there. We'll run a lot of proprietary algorithms. We have big data sets that we buy, and we're looking at everything from how many people, like cell phone data, how many people are in, keep on the topic of Whole Foods, how many people are in that Whole Foods?
Yeah.
And if we look at how many people in that Whole Foods, well, how is that compared to the other Whole Foods? Is that a way of ranking if one Whole Foods is better than the other? So if I have a shopping center and I'm trying to bring Whole Foods, I can look back at the other Whole Foods that are performing extremely well, and I can look at what demographics exist around there. Is it education? Is it the number of people that have a master's degree? Is it the number of household income? Is it the number of cars in the garage? We use all these very, very wide data sets to figure out what made that Whole Foods successful, and then where was the next one need to be? Where can we find those same conditions that made that Whole Foods so successful, so that we can buy that shopping center, potentially put Whole Foods into that shopping center, or attract them to one that we already own? We use a lot of this stuff to figure out those patterns. And it's very nice because retail, everyone has locations, right? So we have 900 and something Publixes in Florida. We can quickly see where all of them are. How many people visit each one? What are the better ones? What are the worst ones? What makes the ones better than the others? And extrapolate that and try and buy successful shopping centers, because at the end of the day, it's an ecosystem, and the retailer can only continue to pay us a proportion of their sales. We call this the health ratio, or the sales ratio. And it's anywhere between 3 and 10% given the type of retailer. If I have someone that's giving me 50% of their sales in the form of rent, even if they're legally obligated to do so, they're just going to go out of business. So we need to find the right tenants that can perform in those areas, and we need to attract them to our shopping center and show them they can be successful there. And then hopefully a certain mix of them makes them even do more sales, if that makes sense.
Yeah, and your data, when I was looking at your data set, it's a lot more advanced than just like, I'm going to ring an area and I'm going to create some kind of Venn diagram system and find the commonality in the middle, and that's my client base. Right. Your sophistication on your software tools has now evolved that, the shapes of where people are coming into a particular Whole Foods is not conformed into, let's say, just rings. Right. It's a very unusual shape.
Yes.
But when you understand it and study it, you can understand that certain arterial roads that leads to that supermarket allow people to get there quicker. And so knowing where you're pulling from and how you're pulling that it's very important. But you have that data for like cell phone data from Whole Foods. Right. And then you have data for other big, let's say, brand names that people recognize, and you have all of that. And I was looking at your screens when we met, and I was like, wow, this is very granular. This is super detailed.
Yeah.
So you really understand your markets coming into real world application. So you've got a lot of data. It's really actually precise. It's very good at understanding the demographic profile within the areas. And the success of the fund, where you are right now, let's go into some examples of funds and how they've performed. So if you're watching this and you're like, all right, I'm interested to know more. All right, you've got my attention now. If I was going to invest in a fund, what can I expect? Let's use a working example. Let's say, I know, $3 million. I'm going to come to you and say, all right, Dylan, here's $3 million. I want to invest in this 7-year fund. I like and believe in what you're selling and the let's say the retail that you're going to invest in, because I think it's a Whole Foods and it's whatever, and it really makes sense. And I see this as a business that's not going to go out, and it's in it's the right location, and all the variables are good. What have you looked at historically as an example? So $3 million would yield you, let's say, what, 8%?
Yeah,
9%?
I'd say so. Sometimes we go a little risk light, so we end up with a closer to 7% return cash on cash. It tends to grow to 8, 9, and 10 as we get later in the fund, and probably averages.
So it matures. It matures like it does with like a lot.
Because the rents grow as well.
Yeah.
So on all of these rent contracts that we have across the shopping center, we're probably averaging 2 to 4% compound annual growth rate in the income stream. So it's not just that the property is appreciating from a price per square foot basis, like just what the valuation would be. It's also the income is growing over that same period of time.
Yeah.
And that, before we sell, is just the result is an increased dividend.
And because of the way it's retail, that hedge against inflation that we're all talking about right now, I mean, the hedge against inflation is something that we've been discussing now in the last couple of years because it's so damn relevant.
Yeah.
I mean, we look at it and we're like, and South Florida inflation.
Yeah.
I mean, just look at the cost of going to the supermarket now than 3 years ago.
Right.
I think there was a study and it said, if you went to the supermarket, to Whole Foods 3 years ago, and you spent $50, if you went today to Whole Foods, that same $50 bill isn't $50 anymore. It's $89.
Right.
Okay.
Right.
So that's significant. That's an 80% increase. Now, against inflation shows nationally it's less than that. But in areas in South Florida, it's much higher. Going out eating, all these things play a role. And obviously, if we're going to move forward against inflation, this is one of the best possible hedges you can look at.
100%. We have two forms of appreciation. Like I said, we have the rents are going up, and inflation shows itself in rent as well. So if I have a tenant that was paying $20 a foot and their lease runs out or they move out and the new market is $40 a foot, that's a big pickup. And we experience that all the time. We call that mark to market. And I'll give you an example. In a shopping center we have in Tampa, we had a big gym taking up, 18,000 feet of space, and they were paying $12 a foot. So we talked to the gym. They wanted to downsize. They wanted to focus on a certain core aspect of their business, which was like the heavy weightlifting, like the real like muscle guys. They decided to take 6,000 square feet. They gave us back 12,000. In that 12,000, we put two other tenants, one paying $25 a foot, double, and another one paying $40 a foot, so more than triple. So that's a shopping center that didn't show up in our original business plan. That's something that we were able to do because inflation has gone up and rent's gone up so much that we were able to unlock that value in the third, fourth year of our hold. So, some of our big winners, we have deals. So rather than speak of funds, because the fund owns deals, I'll speak about specific deals. But we have deals where people have gotten their entire investment back in that deal in 3 years, 4 years. So
when you say that entire investment, you're talking that if they put in $100, they got $200 back. I'm
saying they got $100 back, and they still own, and we're still collecting rent. We still haven't sold it. So we've refinanced it, which the proceeds from a refinance are tax-free, and all of the rents, have continued to go up. So their distributions have gone up significantly.
That's a huge return.
Huge. And it's a deal that probably, just to finish off one idea, that most people will probably vote when we get to the end of it not to sell it.
I would imagine they would. Why would they want to? If you're in a position where, let's say you've got an anchored tenant like a Whole Foods, and then suddenly your peripheral tenancy around there, let's say if you move out, and because of the critical mass and the people coming in, you're able to raise your rents from 20 to 40 to 60.
Right.
I mean, that cash on cash.
If you live in a place like Florida or Texas, you're going to understand this. I grew up in Los Angeles, and it wasn't this much the case, but you get an intersection, you have four corners. And around here, there tend to be almost a shopping center on each one of those four corners. And there's one that's dominant. There's one that's like the cool kids party that everyone wants to be at, and it's full. And those you can really push the value on. And then there are other two that are also great, but maybe they don't have the Whole Foods, or they have a different grocer, that's doesn't drive that same kind of co-tenancy. Then you have another one that's kind of the bad one. The hard thing about the bad one is everyone else is all very established. When you lease something, you build it out, a restaurant or a grocery store, you can't move that very easily. And your customers don't like change either. So the ones that are good tend to stay good and get better faster than the bad ones. It's very hard to pick a bad one that can be turned into a great one. It's very easy, not easy, it is more doable to find one that's just been poorly managed or it hasn't had the right amount of capital put into it. That's always been a great one, but it hasn't had the money to grow into a great one. Those are the ones that we target. Yeah. It's very hard to take something from the bottom quartile.
It's the child with all the potential, but just it's been unfulfilled potential until the right teacher comes in and steps in and
it's the same. Now there's other that are just not that bright. And doesn't matter how many tutor hours you put in. Like, I'm a
amount of tutoring and extra after school curriculum activity is going to help that kid. Yeah. But when you've got the right one, and again, there's a lot of them that might be slightly mismanaged. You guys study enough closely and say, this is a great location. Yeah. And then you get the right tenant, boom.
And I would rather get a 7% cash-on-cash return to something that could be made great over time than get 10% on something that will stay
7
bad.
is still really good. So coming into the numbers, I'm going to put this into perspective. If you put in $3 million, okay, so $3 million, there's your investment into it. And you're getting, and again, you're not waiting 6 months to get yields. You're returning yields every single month. You're paying out in monthly dividends. 7% on $3 million is, let's do the math. It's It's
210.
210. Yeah. So you're at 210. Divided over the year, you're looking at somewhere around it's going to be about 17, is it? Something like that?
Yeah, per month.
Something around that. If you're getting a return of 17 a month, this is net. See, what people normally do is if I sell, let's say, a house for $3 million and it's an investment, we might be trying to yield on that $18,000 a month, right, for rent. Okay, but I've got to pay taxes, I've got to pay insurance, and then I've got to hope that I don't have any additional kind of surprises like an AC breaks or the roof needs repairs. And then I've got to come in and spend money on that. You're talking net. Correct. Not only net, that's at 7. It starts at 7 and then it kind of moves, and it can move, from 7 to 8 to 9 to 10.
Sure.
Then at the end of that 7-year period, you're looking at an upside where that $3 million investment is now $4.5 million or more.
Right.
So the yield is like, if you're giving me 17 grand a month back every month, I give you $3 million, and every month you're going to give me 17 grand in my bank account, net, bang, 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 bang. And then at the end of it, you're not giving me $3 million back, you're giving me $4.5 million back or more. That's a hell of a return.
I mean, that's why we like it. That's why we're in this business. I mean, it's
and that's why the super wealthy guys who own a whole Foods or the bigger players, that's why they make so much money.
100%.
Because they're making it month on month on month. So if that sounds interesting to you, give me a call. We can talk about this. So as we are in May, let's say with beginning of May 2024, how is the market today and where is it going? And what are the forces at play that you're considering are key for your fund?
Yeah. So here's something I like a lot about retail. And I'll talk about kind of what's been the case for retail forever, and then what's also a big thing looking forward. Retail, the survival of the tenants inside a shopping center, it depends on location. So the famous adage, the location. Mm-hmm. Shopping centers tend to be the most well-located assets in markets from a perspective of visibility and traffic counts, the number of cars, driving by them, and just proximity to everything, especially these, what we call strip centers, these open air retail centers. It's about convenience. So if I have the most convenient location, it's going to be convenient for anything, right? Whether it be a shopping center, whether it be a hospital, whether it be a hotel, whether it be an apartment building, it's a convenient location. So one thing about real estate, as we all know, is you can't move it. So we like buying these locations that are super well located and that happens to be retail. That's been a forever thing.
So these are the corner on major intersections.
Yes.
We're not talking about like the Merrick Parks and the Bal Harbors of this world.
No.
We're talking about going down, I'm thinking of like a main arterial route where there's a corner of two big streets that intersect each other, that you'll then say, all right, there's a lot of traffic here. There's the right demographic profile around.
Right.
And no matter what's here, whether it's a Whole Foods, a Target, a condo building, a hospital, or a medical center, all of those it's a good location.
Correct.
For that, regardless. It's as bulletproof as it could get.
100%. And they're one story, right? So if you're looking at something that's a hotel or a big multifamily building already, it's almost already at the highest and best use, meaning it's very hard to knock down something that has 15 floors of revenue. Whereas here we're looking at one single story. And I bring this up because I think retail is changing. I think it continues to evolve. And we have lots of projects where we look at what the future is going to be. Is there a potential that we can knock down, if it's 150,000 feet, can we knock down just 30,000 feet and build 300 apartments? That would be an amazing outcome. We have one deal where we're looking at that right now. Is it later going to be, we have one that's across from a hospital. Does that hospital need to expand and things like that? So we know we're in the game because we're there. Now, for the most part,
you're buying the land. It's the land purchase that you're making here. Yeah. The tenants that go in it just depends on what's fit for purpose at that.
I have two components. I have the land underneath it, and then I have a bunch of leases. The legal obligation of these national companies to pay us rent. Yeah. So I look at a lot of time as it's like a collection of cash flows from a lot of great companies, some publicly traded, some with amazing balance sheets, some with okay balance sheets. But I buy a shopping center and I get a great piece of land and I have 15 to 20 contracts to pay me a monthly rent. That's how we look at it. And so I love the location. I love the diversity of the income. A lot of these centers that we bought, they're performing extremely well. And we can't really do anything because they're having an amazing time as a shopping center, and we're able to move the rents from $20 a foot to $40 a foot. So there's enough of a value add right there that we don't need to get too complicated. But I see right now moving forward, last year we were off about 70% on transactions, rising interest rates, these types of things.
So explain 70% off in what does that? What does that mean?
If on an average year in Florida, we should have sold 100 shopping centers, we sold 30. And that's because a lot of people were just concerned, like, when is this interest rate increase going to stop? And what would happen is, the buyers would have demands. If I'm going to buy this at a 7% cap rate, the unlevered return, and my debt, my interest rate is 7%, I don't get any value to financing the project. And a lot of what we do is we can get extra value by putting, let's say I buy something that gives me a 7% return and I put 5% interest rate on it. There's an extra 2% there that I'm making. But it's called positive leverage is what we call it. That disappeared for a while. So what would happen is the buyers would say, we're not buying for less than this. And the sellers would say, no ways, my property's worth double that last year. The sellers finally moved their expectations down. And just when the buyers were getting close, the interest rates went up again. And then the buyers had a new expectation about what things should cost. And it's just been what we call a bid-ask spread. There's just been no transactions because the market was moving. What's interesting right now is the sellers are listening. I think values have come down a little bit to a healthier rate. Right now, if you're getting a loan in our world, it's going to cost you between 6 and 7%. 4 or 5 years, it would cost you 3%, right? So what that did is it made every deal look like a good deal. When you can borrow money for 10 years at 3%, everything works.
Exactly the same in the residential market space. It was almost like, look, even if I'm overpaying,
who cares?
Who cares?
Free money.
Exactly. And that happened for a long time. And now, what we have right now is exactly the difference is the phenomenon in the residential market is the psychological spread between the buyer and the seller, with the slowdown in our transactions, is not met or it isn't being realized, the sales won't uptick until these buyers and sellers can have a meeting of the minds.
Right.
And right now, the meeting of the minds isn't happening as fast as it should. You are saying within your market, there is that gap is now shortening. The sellers are becoming more realistic.
Absolutely. And what that means is some of the sellers, we have funds, like we talked about, these 7 to 10 year life cycles. So we have certain funds that are expiring, that they've promised to give the money back. So they are now liquidating the assets in the fund. It's a new market. Fortunately for them, I think income went up high enough that they're not losing money on behalf of their investors. So they can still sell and look okay with their investors, but they're not allowed to take that much out of the appreciation. They've got to kind of leave it for the next guy now and sell it to us at a more normal price. There's also a lot of activity in the REIT world. Those are the publicly traded companies that own a bunch of real estate investment trusts. Mm-hmm. There's some interesting dynamics happening right now where they're spinning off, they're breaking apart, and that's putting a bunch of properties into the market, which is going to be very good because it's going to just add deal flow.
But those yields, and again, excuse my ignorance here, but those yields that are 7-8%, why are they feeling the need to sell them? Is it because what's the you said transactions are down by 70%. If these are yielding these high returns, why are they selling? Why aren't people jumping on this? Why isn't there more people jumping on these deals and saying, "Oh my God, that's 7-8% with upside"? Why isn't everyone plowing into this?
So one of the things that we've done that differently than most is, while we do have our funds, we also take direct ownership in real estate, and a lot of that. The purpose of that is to hold it for a longer horizon. When you try and time the market perfectly, it's very hard. We call it, a lot of these people have to end up selling what we call green bananas. Like it's time to sell, but it's not ready yet. So sometimes one of the best things you can do is just buy one of these forced sales, hold it, do very little, and it appreciates. So a lot of the institutionalized part of real estate investing at this larger level, these are asset managers that are managing billions. Right? So their job is buy 300 million, sell 150 million, buy 300. They don't have time to think about the individual assets. They're running a different process.
They need to keep trading.
They need to keep trading.
Because from their point of view, it's kind of like the classic, I don't know, let's say hedge fund or stockbroker mentality, which is I make money when I'm trading. Right. As long as I'm always be closing. It's like always trade. Regardless of what the yields might be, they've got to keep trading.
And one of the biggest things on their scorecard, on their report card is, did they give the money back on time? So whereas I think most individuals and high net worth individuals would rather say, you know what, let's have a vote. Let's hold this 2 more years. I would rather sell this.
But there's too many people to get them all together to get them to agree to hold.
In their world, it's way too big.
Yeah, it's a dinosaur.
In our world, we can talk about it. Yeah. We can go to everybody and say, can we extend this? We think that this is a good way that if we could sell this today for 20 or sell it tomorrow for 25 and do nothing. Does everyone want to stay and wait for the 25? We have that flexibility, because of our size. If you're one of the largest pension funds in America, you cannot do that. You just simply need to get your money back because you have new obligations, new things that you have to work with. So it's a little bit different. And I think our structure and our size allows us to do things a little bit differently and take a longer term approach to real estate, see it more as, like we talked about, that one that's doing so well. Why sell it? Why do you want to go sell that to buy something potentially inferior and then try and get it, if you're lucky, back to that same level?
And if you're now nurturing and you're up to that 9-10% rather than at the 7%, and then the value of the asset's going to keep moving,
right?
Stay in it. I guess the guys who are too small, they're individuals, they don't have the money to buy this.
Right.
The guys who are too big have too many obligations and too many people at the party, at the table, that they can't hold it. It's too difficult for them to change their formula.
Right.
So that means there's a gap right in that middle ground, which is where you guys sit, that allows you just the right number of investors that you can engage with all of them, 10, 15 people, and say, hey, let's look at the returns, let's make the call all 100%. Together and decide.
100%.
So let's say you have a fund and it's 7 years, but some guy says, I really want to get out.
Right.
And everybody else wants to stay in.
Right.
How does that work then?
So there is no secondaries market for what we do, meaning you can't just simply hit the sell button and there's a counterparty to accept the trade and you sell. In our market, the way it works is, we have to help you find somebody. If you know somebody and they're a qualified investor, we can help you make the trade. But if you want to leave before we have that exit period, there's no valuation. So what we do is we ask people, we enforce that people leave at par. Meaning if you put in $1 million and you want to leave before we reach the end, you got to leave at $1 million.
Yeah.
And you've got to do some adjustments because you've probably taken some depreciation. We can talk about taxes a little bit later. You've probably done some things. So you're probably having some type of adjustment with your buyer. 9 times out of 10, someone in the group will buy your shares because everyone else is very happy.
So if they're yielding that kind of returns, I can imagine that they would. I mean, I've got lots of assets where actually I sell a house to a guy and he's getting a really good return. But he goes, you know what, I've got this opportunity happening wherever and I really need the money out.
Right.
I've got somebody who said, you know what, I'll take that deal.
Yeah.
And again, the reason we're having this dialogue is because I'm trying to open this conversation up to, I call it the everyman, because it is a high-level investor. I do with high-level investors. But those who may not have thought of this type of investment mechanism,
right,
because it was too avant-garde.
Yeah.
It was too many moving parts. They associated it with the big institutional groups where they're amongst thousands of other people and they therefore have no control. Now you're talking a much smaller group where you can explain to them in more detail about what this is, and it's easier to process. It's closer to buying your own home to invest in that. But in this case, you're not buying the home or the condo. You're buying the dirt that it sits on, and you're enjoying letting someone else take the risk and the liability of maintaining the property. And you're going to enjoy the yields, and you're going to see the appreciations. To me, it's actually a very high return, lower risk game than many other asset forms that we deal with. And that's why it is an interesting model and something that I think many people don't consider.
One thing I'll tell you is that this is the beauty of this business is it's extremely simple to understand, but it's very hard to execute. So any one of our investors, I can take them into any one of the shopping centers that we own, and they're going to see why it works. They say, wow, I see people going to the supermarket all hours of the day. The doctor at the corner there, he's very busy. This is the perfect mix of things, right? I got the juice bar next to the gym. I got the dog groomer.
So people can do that? Sorry, I interject.
Yeah.
But so if I'm an investor and I'm going to say, I'm going to give you $3 million to invest in this, and you say, you know what, David, we're going to buy this Whole Foods, and we're going to buy this dog grooming place, and this and this and this in the center. I can go there and I can check it out.
Yeah, we can go together.
And you're going to be like, what do you think? And I'll be like, hey, I can see this.
Makes
I can
sense.
see
you can see why it does well.
And I can look at you will show me the balance sheet so I can see how much they're making and how they're working.
Well, we don't see the balance sheet there. We could see if we're under contract to buy it, the seller will have shared with us the last 3 years of their financials, what the property's balance sheet looks like. We won't know about the actual retailers unless they're publicly traded. That's all confidential, and they don't share that.
But the rent that they're making, and
we know the rents, we know everything when they expire, what
Okay.
the market rates are. We'll have done our study. A lot of times it's very simple. Like we just wrapped up a deal right now in Fort Myers, and you go there and it's very obvious that you're in the best intersection in the market. Then you can go drive the 4 or 5 centers that we compete with, and you say, wow, the one that we were in, that's the one that we're buying, feels like it has the most energy, the best tenant lineup, a few things that I think anybody probably that has $1 million or more to invest is going to understand.
Yeah. I understand it very quickly. I think it's actually quite an easy thing to really process and understand and get your head. It's not too abstract.
No, and the hard part, which is why we have a job, is that each lease is 120 pages. Operating these multi-million-dollar operating budgets a year and making sure that everything's clean and taken care of, and you're not, because you can get in default with your tenants as well. If you don't do your part of the job as the landlord, you're in trouble with very big companies that demand excellence. So, the operations is complicated and tedious and long, and it's hard to do. And that's what we do, I think, better than most. But the underlying profitability of how this business works and what makes it tick and how you make money, I think is very simple to understand. Well,
it's been around forever. I mean, let's think about like retail as a concept. Now, in terms of like people look at it's the commercial conversation, and they say multifamily is taking a little bit of a softening hit, as is industrial. retail's having its moment. Why is multifamily softening? Why is industrial softening? I mean, you're focused Florida, so let's keep that conversation in Florida. Because I think if anyone's looking to invest, they're going to want to understand this. And again, this will follow up, and there will be a follow-up podcast where we'll have you and Ellie, and we'll get very specific about investments.
I look forward to that.
But just as an overview, just talk us through like how that landscape, that Florida landscape looks and why it looks the way it looks right now.
There's a big, anytime you have a little bit of a boom and bust, and I don't think we're in a bust by any means, but anytime you have this, it's things ebb and flow. Mm-hmm. And what normally pushes things over the edge is the supply side of the equation. So you have supply and demand. And we tend to overbuild. And when things get very, very, very profitable, people overbuild. The thing about shopping centers is we have enough of them already. If anything, we're slightly over retailed, I would say, by our metrics and our personal viewpoint as a firm. We think there's too many shopping centers in Florida. You know, we could probably take losing 20% of them. It wouldn't affect a lot of people. So what's good is there's now a flight to the better properties. We can get rid of the bad ones. We can turn them into something else, and there's a flight to the better properties. But very few are being built every year. The ones that are getting built are normally getting built as part of a larger project. There's a couple apartment buildings. There's a hotel going up. It's like kind of a mixed-use development, if you will. But just the old buildings that the shopping centers that we buy, they're anyway are built from the 80s to 2010, 2015, I think is the newest one we have. You know, those, we're adding 1 or 2 a year, tops. So we're not oversupplied. And the good corners are already taken. So it's not this situation where you have softening rents in multifamily, and then on top of that, you have 10,000 units being delivered the following year, which just makes the landlords compete against each other. So when nothing new is being built in our trade area, the landlord has a little bit more power and could say, if you want to serve this trade area, this is the market rent. If you don't believe me, go across the street, ask them what their rent is. And we do that type of stuff, and our software helps us do that type of stuff. So I would say the number one advantage right now to those other two asset classes you mentioned is the lack of new supply in our favor.
And it's like with every market, it's very specific. I can draw the analogies in the residential sector where traditionally we would see areas like Brickell and Downtown and Edgewater, which between 2011 and 2015, there was an enormous amount of construction, and everything was underpinned by the rental incomes.
Right.
And all the people who were purchasing were mostly South Americans buying to invest, to rent out. And the rental numbers, you know, obviously they were doing really, really well. And then you suddenly injected, you know, thousands and thousands and thousands of condos into the market, all being rented. And then, of course, optionality increased, supply increased. Tenants looked at it and said, nah, I can get cheaper rent. Rents dropped. And because the value of the asset was underpinned by the rent, the values went up of the unit, but then the rent stopped matching the asset value. Right. And when that happens, that's when you see corrections. And that, you know, we talk about that extensively. And I always say, and it leads to the final question, which is, what is the better question? What are the right questions to ask? Because I think a lot of people, when it comes to investing, are asking the wrong damn question.
Yeah.
And so, to your point, the retail, having the right quality, because people always pin, well, there's too much product over here. But then if you look to a particular type of asset that people want, let's say in our case in the condo market, it was large luxury condos built for primary residence. Mm-hmm. They didn't have enough of it. Lots and lots of 800 square foot units, lots of 900 square foot units, right. Thousands. But if you wanted to buy a 3,000 square foot unit in a luxury condo in Brickell, good luck to you, because you probably weren't going to find it.
Right.
And so those ones went up. And again, the supply of that, it was a different crowd.
Yeah.
Not the same people buying the product systematically. Right. One were investors and they were 23-year-olds renting condos for like $4,000 a month. Right. And the other was an empty nester wanting to live in Brickell, or a high-level earning professional who wanted to live in Brickell because his office was there. He was a hedge fund guy or something like that. And he wanted to spend $4, $5, $6 million on a condo, couldn't find one. So I guess what you're saying is that it's not all equal.
No.
The retail is not all equal. And yes, there's stuff that there's too much of it, but that's not the same as these prime corner intersection retail spots that you're talking about. And those are the ones that you're looking at.
We're very selective to the detriment of our own growth. I think people ask a couple wrong questions. I think there's people get seduced by yield, high yield too much.
Yep.
So everyone's like, wow, that that 10 might not be worth the extra 3% versus our 7. And, you have to start to learn the business. I think you always think about, getting very basic now, even how I make decisions, because I'll invest with other general partners and other asset classes as well. Who's running the deal? That's my first question. Do I think this person can execute on the strategy? So that's the most important thing. You have to get to know the person, their background. He or she is going to have to explain to you what they plan on doing. And then whether you know the business or not, nothing that we do is that complicated. You should be able to see, does that make sense or not?
No.
If I tell you I'm going to take this horrendous area and put a Whole Foods in it, you're going to be like, that seems awfully simple. Why has no one ever done that before? Yeah. Maybe it's not possible. So I think the first part is who's running it? What are the qualities to run it? What's the business plan? And then what needs to go right for the business plan to work? Oh, I'm going to build 800 condos. The largest building around there's 200. Do I think this guy can somehow get 4x entitled that the last guy did who was pretty smart? Or does that sound like maybe that's not going to happen? So it's always like, what's the business plan and what's the likelihood of success? And is the person that's pitching it to you the right person to actually execute it? Do they have the tools and the team to actually execute the business plan?
Yes, there's detailed questions, because I think people make massive assumptions sometimes.
Yeah.
And and I see it all the time in my industry. I see it all the time with people saying, we're going to build this amazing condo because all these people are moving to Miami. And that's like the end of story. Drop the mic, walk out of the room. I'm like, yeah, okay, it's not quite that simple.
Right.
Yeah, but they're moving in, but where are they moving and what do they need and what are their driving forces? And are you building what they actually want to need? Because a lot of the time they assume we're building this thing and they're going to love it. And I'm like, well, you're not building what they want.
Right.
You're not playing to the audience.
Right.
And that's one of the big issues that we see, I think, in Florida in general. There's a lot of like just blanket statements that are
100%.
made, which I think are just so dangerous. And I get it every day. I get calls every day. I had 2 yesterday, and a guy said, my friend said I should invest in this condo. And I said, well, my model, I don't like generic. I like generic crap. It's just generic.
Yeah.
It's like buying a Honda. There's nothing wrong with a Honda, but it's not going to go up in value.
Right.
And they're going to build one just like it in a few years' time, and it's going to be replicated, and it's going to be replaced. And that thing that you've got that's new and shiny that you've got right now is going to look old and kind of knackered.
Yeah.
And he goes, but it's amazing. And I'm like, sorry, it's bollocks.
Yeah.
Whatever. I was a little direct over it. But I said, you're misinformed, and people take stuff. And I think that this is why this kind of dialogue, there's a formula to good investment decision making.
100%.
You see it, I see it. I hope the audience watches this, sees it, and understands it. And when you get it right, and you just have to pay attention to the signs, like flying the plane, looking at the dials, pay attention to the dials that we give you. If you do that, it's blue skies.
It should be blue skies. And normally, if you have an honest person, there will be problems. They will communicate the problems, and they will deal with those problems better than anyone else could have. And that's all you want. Yeah. I really don't think anyone can promise perfection, because the world changes.
Yeah.
COVID was a big deal for us. All of a sudden, we went to no one's going to be able to sell anything. All these people are not going to pay rent. The bank's going to foreclose, the whole thing. And we didn't know how long it was going to take. And fortunately, in Florida, it worked out pretty well. But, we suspended our dividend for 3 months, made our game plan, started collecting all the rent we weren't sure we were going to collect. And we ended up giving everybody all that money back. And we collected 97% of our rent. So, but what do? We communicated to everybody. We said, we don't know how this is going to turn out. We need all the money that we have on hand to pay our debt service, so we don't have the bank stepping into a position we don't want them in. And then when we worked it out, we communicated on a bi-weekly basis. In the third month, it kind of went away for us. Yeah. And we were able to go back and give everybody the money that we withheld. And it worked out perfectly. That's what I want as an investor too. I always invest with other people for 2 reasons. One, it gives me exposure to other asset classes that I don't directly invest in with our firm. And 2, I see how other people do things as well. I see how they communicate. And that's what I look for. I look for someone that's going to tell me things as they're happening, not try and pretend they're perfect and then hide things.
Well, what I liked when we had our conversation is you explained things to me in the simplest way. And I said, look, explain this to me as someone who has no idea about this area at all. I'm in real estate, but I don't understand this. And you did. And I think I appreciate that. And I think that's so important, because I always say, look, if you want to make a decision for investing and you call us and look, I'm happy to, what we'd do, anybody interested in this is give me a call and we'll get on the phone. We'll actually have meetings. And you said, look, I'm happy to meet with investors and explain to them and do so in a way where it's like, I'm going to explain in simple terms, because if you have to invest in anything and you call, let's say, a guy investing in the stock market and he says, well, I just have this feeling this is an amazing investment. Trust me.
Yeah.
I'd be like, run away.
Yeah.
If it can't be explained to you in simple enough terms and not with like general broad, what I call like statements that are kind of clickbait-esque, if you can't be explained, I don't see why you should make that investment call. Don't make that decision.
That overcomplicate things. I mean, there's a saying that's saying the mark of a charlatan is someone that overcomplicates things.
Yeah.
I mean, it means one of two things. You're trying to confuse your counterparty, or you don't understand your business well enough. You haven't been doing it long enough.
That's the thing. If you can't explain it simply, then you don't understand your product well enough.
So for me, not to sound that we're oversubscribed and never going to need investors here, but we're selective about our investors as well. It's a partnership. I have to spend 5 to 7 in some deals that we have them in permanent structures, meaning we have no intention of selling them. So these are my lifelong partners. These are marriages. Yeah. These are people that I want to be friends with, that I want them celebrating. I want us to celebrate. I want us to make decisions as a pack. I want us to understand each other's motives and do all.
But you explain the risk as well.
Absolutely.
That's the thing. Explain the risk, because there's nothing worse than coming in, and I've had this happen myself, where I invested in markets, invested in stock market. I took faith of other people. I didn't understand that market well enough. And they said, well, they didn't understand my appetite. Understand your client's appetite for risk. Yeah. And then once you understand it and you can appreciate it, you know that as they go through the period, they're not going to get jittery. They're going to hold on. They're going to stay the course.
Right. If we look at a deal and I'm saying, let's say we go to that shopping center the way we discussed, you say, what are the risks here? Where can we really get hurt? If the little shoe shine guy for 1,200 square feet moves out, you're not getting hurt. What could happen? Well, if the Whole Foods moves out, that would hurt. So then now we just need to decide, and everyone has to do their own calculus.
What's the probability of that?
What's the probability? I'll tell you what I think based on the data, but also go inside. Look on the shelves. Are the shelves fully stocked? Are people happy there? Does it look like the place is doing well? Or does it look like a dead zone where everyone's like about to move out? Like when you would have walked into a Bed Bath & Beyond. Yeah. Nothing was on the shelves. Everything was on the floor. It was disorganized. It was a company in disarray. Yeah. So you can see these things with your own eyes and make your own decisions. And we ask our people to do that. We say, this is the information that we're privy to. Based on our expert opinion, this is what we think will happen. If you agree with us, let's go. If you don't, that's okay too.
And I try to layer into this, and this is why we're working together. I'm going to layer into this with my data. Let's say it's a Whole Foods and you walk in there. As I understand new developments that are going up around an area, and I see, let's say there's going to be 2 major towers. Yeah. And I know the price point of that product and I know it's all sold out. I'm going to be able to say, you know what? You've got a good source of revenue. You've got a good source of people over here who are going to buy that product. Right. And they're going to keep that business going. 100%. And if you like it now, they haven't even moved in because that building isn't open. Right. Imagine how it'll be when it opens. These are the things, that critical mass that really kind of
I just love how evident these things are to the eye. If you have a center across the street from another one, the Aldi's full, the Whole Foods is empty, maybe it was the wrong market for them to go into. And then when they have the chance to get out of that agreement that they made, that lease, they probably will. They'll probably close it. Remember, rent's only 4 or 5% of their sales. The other 95% of their expense ratio is going somewhere. So where's it going? Probably to the people, to the staff, to the stock, to the inventory. So they're probably not going to keep that up just because they have that thing built out. They're going to want to move. But you can see these things when you go there. That's the beauty of our business. And we make it more sophisticated and we explain more things, but you can still make sense of it with your own eyes. You don't have to take my word for it.
Yeah. And that's the key. Don't take anyone's word for it. Look for it for yourself and your eyes will be opened. Dylan, we could keep on talking. We will do another podcast on this. Sure. We will get hyper-specific about the existing, opportunities right now in the markets. I want to thank you for doing this first podcast with us.
Thank you.
It's a super interesting subject area. I've decided, I spend a lot of time talking about investing. And again, right now, I know a lot of people out there are really confused about where to put their capital, and they're deploying it and they're pulling it from, different asset areas. And I know real estate is something that it's part of the equation. Yeah. And if you would like to know more, again, see information below. Please DM me. If you've got questions for Dylan on the next pass that we're going to do, send them to me. I'd love to hear your thoughts, what you think, what you want to know. If you want to dive deeper, if you'd like a one-on-one, give me a call. We'll set up. There's another fund that's going to be opening, I guess, soon.
Yeah, we're in the investment thesis process.
In place, and we can, explain that, or Dylan can explain that. And, again, the third wheel in this is Eli Braha, who's involved. As always, thank you for watching. If you want to make good investment decisions, make sure that you tune in to those people who are open, clear, can explain, and have access to the data and the information that you wouldn't otherwise have access to. Because if you do what everyone else does, you'll get what everyone else gets. So we're trying to give you something that you wouldn't get elsewhere. Thank you for watching.
Thank you for having me.
Dylan, thank you very much. And stay tuned soon for another edition of the Better Decisions podcast.